Pride Partners International's monthly webinar. Thank you for joining us today. Pride Partners International is a global partnership of firms and specialists in transfer pricing and financial valuation. The association is the meeting ground for professionals capable of facing a challenging business environment, helping them connect to boost their continuous professional development and enhance their technical and human skills and abilities. This partnership is made up of experts recognized by their trajectory and prestige in the transfer pricing and financial valuation fields. Experts that constantly participate in the exchange of technical information, knowledge development, and implementation of global best practices. When a firm joins the PPI partnership, it increases its scope immediately and exponentially. Business becomes much simpler by accessing training, technology, resource optimization, and new business opportunities, among other benefits. We invite you to learn more about Pride Partners International. Contact our agents and be part of the global elite of transfer pricing and financial valuation consulting. Our transmission will begin shortly. We invite you to participate actively by sending all your questions or comments through the live chat. Again, thank you for watching, and we hope you enjoy the event.
Good afternoon or good morning to you all. Welcome to our webinar, How to Perform a Best Practice Benchmarking Study. My name is Henk Monen. I'm the CEO and founder of TaxModel. And with me, I have with me my dear colleague, Lisanne Valks, and maybe a few words from Lisanne as well.
Hi, good afternoon, everyone. My name is Lisanne Valks. I am one of the TP managers at TaxModel. I've been engaged in the subject benchmarking quite often, and it's one of my main tasks every day. So happy to inform you about benchmarking today.
Thank you, Lisanne. Yeah, just a few words on TaxModel. So TaxModel is born from the vision that they want to contribute to a more transparent world. Software helps in the transparency. There's a lot of talks about the ESG and the corporate responsibility, and we believe that software will help in easing the flows for corporates and for intermediaries, at the same time also offering a nice, more transparent view on the workflows. So our mission is to help corporates to become globally compliant, and also to help intermediaries, for example, with benchmarking, which we're discussing today, in the compliance process, and to also offer the insights. And for that, we build our standardized solutions. So we typically are focused on what we call the direct tax control framework. And within the direct tax, we are focused on transfer pricing, where we have tooling like the benchmarking tool that we will show also later during this webinar, documentation solution and country-by-country solution. Besides that, we also offer solutions around tax provisioning, and also for next year, we are anticipating on the Pillar 2 environment. And then finally, slightly out of the ordinary with the regulatory part of taxation with DAC 6. And all that is also supported by our service lines, where we help clients in the onboarding, but also perform benchmarking for both corporates and for intermediaries. So maybe also something on the agenda of this webinar. So first, Lisanne will say something about the 9-step approach as per the transfer pricing guidelines 22 of the OECD. Then we will do some deep dives. First, how to set up a benchmark analysis. Then some words on how to do a search strategy in an external database. Next to that, the rejection and accepting process, the PLIs and the adjustments, or profit level indicators and adjustments. And then finally, with the review process, completion and audit trailing. And at the end, we will have some room for Q&A. So also maybe that's the reason why not so many multinationals or corporates are performing their own benchmark streams, is that it's an atypical stream. It's partly, of course, driven by the OECD guidelines, but at the same time, it's also a different way of working, where you need the guidance from experienced transfer pricing professionals. At the other side, you can have people that even have a non-tax background still performing part of the work, which we also explained during this webinar. So the learning objectives of today's webinar are, how to set up a benchmark analysis, how to set up a search strategy and to filter data, how to reject and accept companies, how to select your profit level indicator and to perform adjustments, and again then to review, complete and audit trail your benchmark analysis. And now over to Lisanne for a quick overview of the 9-step approach from the OECD.
Yes, thank you, Hong, for the introduction. We'll head to the 9-step approach of the OECD. So the OECD has dedicated a whole chapter and has to the comparability analysis and has made a 9-step approach how to do a comparability analysis or the benchmarking studies eventually. The first step is, of course, the determination of the years to be covered. So we need to check what are the actual years that we are going to eventually check or set the prices for. The next step is that we analyze the circumstances of a taxpayer. So we look at the industry data, we look at several economic factors, regulatory, competition, all these kind of aspects of the taxpayer we'll look into. And it's basically the basis of the benchmarking eventually. The next step is understanding the controlled transaction. So the controlled transaction in this case, of course, is the intercompany transaction that we're looking at. We check if there's a service, if there is a product that's flowing, are there specifics to this particular intercompany transaction, and who, of course, is the tested party. So in normal cases, the tested party is, of course, the party who has the least complex functions in the transaction, and that is then the party that we'll test. The fourth step is, in this case, checking if there are internal comparables available. Usually these aren't available because we'll do a benchmarking study, but the internal comparable is checking if the company has a transaction with an external party that is completely similar to the internal ones. Usually that's not the case, so we'll look at external comparables. So we're checking how does a third party behave in a third party transaction with third party circumstances. So usually we can say there are no internal comparables available. The OECD guidelines then state that we are definitely able to check databases. So databases usually contain information about the external comparables. So companies that are indeed engaged in a certain intercompany transaction in a certain industry, that they have a certain arrangement available, all those databases will check after, of course, deciding on all the circumstances. So the determination of the available sources is the next step. Usually, as I said, we have a certain database available. Lots of companies have different databases available, and we're not set on a specific database. And that database we use for the companies. The OECD guidelines further state that there are basically two separate approaches. There is the one that's called adding up. So basically, I am a very expert in a certain area. I can say, well, these 5 companies are comparable to the tested party. I can check that those 5 companies, if they are indeed comparable, and I will say, this is my benchmark. But of course, it's very unlikely that all those 5 companies will definitely be accepted because there might be different circumstances. So the most usable approach is the one that starts with a big set, and then we'll go through that set and checking if companies should be rejected or not. This approach is what we call the benchmarking study, of course. Then the next item, or well, not necessarily next, the OECD guidelines also state that steps could be next to each other or similar to each other. So we, of course, select the appropriate benchmarking method, and we use check the profit level indicator. So usually we know upfront which kind of transfer pricing method is being used because that impacts the certain different benchmark study that we're going to do. Then we do the actual benchmark, which is step 7. So it's the identification of the potential comparables. So this is what we refer to rejecting or accepting companies. The OECD guidelines state, and I'm not quoting, that this part should be transparent, systematic, and verifiable. So they state that this particular step in the whole benchmarking study is, of course, the basis of everything and should be clear on why you decide to accept or reject companies. And that's the main task, basically, of the benchmarking eventually. Then there could be making an adjustment. So it could be an adjustment on the financials or accounts, working capital adjustments. All these kind of adjustments could take place after we have decided on what will be the eventual set. And then the final step, of course, is the determination of the arm's length remuneration. So we have now accepted all the companies in the set that are comparable, and we decide, okay, this should be the arm's length remuneration. For OECD, it's sufficient that we have the 25th to the 75th percentile, but we know that for other areas in the world, there is a slight change. So of course, you need to make sure that the calculation is set all right, and that you have the right percentiles. That's basically very easy, the 9-step approach explained.
Okay, thank you, Lisanne. Then maybe on the next slide, what I try to do is at least, and you will recognize part of what Lisanne already mentioned on the 9-step approach, I try to visualize the scope of a benchmark. So typically, there are you have a controlled transaction. If you look at the middle of this picture, you have one side party A and the other side party B. So there is a controlled transaction. Next to that, so part of what Lisanne mentioned is that you will also look at, okay, the circumstances. So there will be the functional profile and also to determine typically who is the least complex party within the transaction. So who has less of functions, less of risk, and less of assets. And that typically will be seen as the one to be tested in this transaction. Now, the control transaction itself can typically be split in 4 different types of transactions relating to goods, services, financial transactions, royalties. And you also determine typically, okay, for which year do you do a benchmark analysis? So most cases, it's a checking event. So where after the fact, people are testing whether the margin achieved fits within the benchmark analysis and the range that comes as a result from the analysis. And sometimes if you're really in control and you have implement an operational transfer pricing system, you can also incorporate, of course, a benchmark for the future setting. So basically for budgeting purposes, that you already determine at least the targeted margin, because from a budget, normally a budget will never be achieved. It will be slightly lower, slightly higher, or very different. So you may have to do some adaptations, but at least you can target what you consider as an arm's length margin on the specific transaction. If you then look at the actual studies, so what Lisanne also mentioned, that you first check, is there any internal comparable? So typically meaning that, are you transacting as a multinational with third parties yourself in a similar way and in similar circumstances as with regard to intercompany transaction? Those often are difficult to find. Typically it's done really only intercompany basis, but you have to do the check to at least verify if that's available. If it's available, it becomes also easier and you can even skip doing the actual benchmark analysis. If you then look at the external comparable, so it means that you're going indeed to an external database, third-party database, which typically in the market from goods and services like TP Catalyst, Thomson Reuters, Capital IQ, local databases like in Poland, the Quick database. For loans, you have Standard & Poor's, Loan Connector, royalties, royalty stat, royalty range. Those are typical examples of known databases in the world. As a next step, then, okay, it's a different picture, but it also shows you slightly, we also highlighted the parts that we're discussing at this stage. So the first part, the client intake, that's getting to know the circumstances, and then you go into slightly automated environment with an external third-party database. The other steps we will talk about later. Typically, that's done on a manual basis by most users in Word or in Excel. Word for the report, Excel for the financial analysis. We have developed a tool called TP Benchmark, where we have automated the main time-consuming elements of this process. So if we go to, again, the determination of the scope of the benchmark analysis, the first step is indeed for which years is the analysis done. So I mentioned price setting and price checking. So maybe we can already skip to the next one. It will be a bit of open doors. Again, who's the relevant party in a transaction? So typically, there's one of the two is least complex. It can be the company performing management services, and the other one is like a full-fledged entity taking those services from the headquarters. The one providing is then typically a least complex entity. It can also be like a limited risk distributor that is buying goods from a full-fledged manufacturer or principal profile company, and the LOD is the least complex entity. But that's something you determine based on the functional profile, again, looking at functions, risks, and assets. Sometimes you have what we call a profit split situation, where you have two complex entities, difficult to determine who's the least complex one. And then you will do a different kind of assessment based on an allocation of profits and losses on certain percentages. But you still sometimes try to support the performance of the two parties in the transaction with an external analysis or an internal CAP analysis. So you can still use it in those transactions, but it's kind of more supporting to your choice for the split in profitability. So again, a lot of repeats in the sense that what is the transaction about? Important to know what kind of products, what are the functions performed, because that will help you in your actual analysis to test the comparability of the companies within the database. And that's again the internal CAP. Does it engage in similar transactions already itself with third parties? Often a quick check, and usually the answer is no, but sometimes you're lucky and you find a good comparable. Often with financial transactions, if you are doing a back-to-back loan, for example, in the company which is linked to, for example, a revolver credit facility, that revolver coming directly from a bank can act as an internal CAP. And you may only have to add something for the treasury activity supporting the activity itself and not in relation to the interest rate being applied. And now up to Lisanne again with a bit of a deeper dive on the search strategy.
Yeah, thank you. I'll explain the search strategy, and here we have different setup, and I want to make clear that this is our approach. This is not necessarily how every company does it, but it doesn't have a high overlap with other companies or other boutique firms. So usually we start, of course, with the region. We want to make sure that, for example, a European company that we're looking at is in the European region. It might be uncomparable if we compare a European company with some company in the US or in the APAC regions. So first we start with making sure that the region is set all right. Then the next steps, so usually for us it's step 2, 3, and 4, we exclude group companies. And the reason behind this is that we want to make sure, we want to test what a third-party company would receive, would generate in third-party circumstances. And that does automatically mean that we cannot have any groups involved in the set. So that's why we have multiple steps in this case to exclude all the group companies that we have. Then the next step, step 5 and 6, we want to exclude companies that don't have data. In the end, we need to make a financial analysis. We need to make sure what the financial results are, and that can only be with companies that have data. So we need to make sure that the companies in the set indeed have data available. Then the next step is to exclude loss-making companies. Usually, this indicates that a company is in a different position than our tested party. Sometimes we skip this step and we include those companies, But we often see that all the companies that are in a loss-making position are not functional comparable to the tested parties. Then the next step, we only want to have companies that are active, companies that are actually doing business today. So we want to make sure that all those companies are included in the set, and thus excluding all inactive companies, companies that are in liquidation phase or dominant, any reason at all. We need to make sure that those are excluded from the set. The next step, step 9, is to exclude all startups. The startups may have fluctuating income, they have perhaps high investments and generate different results. Usually that's also uncomparable to businesses on going concern. So we need to make sure that we exclude all the companies that are startups. And then the final step, usually, is step 10. And this is the selection of the industry codes. This is usually the most difficult step in the whole approach, because here we need to make sure that the service or the goods that we are benchmarking, at least the intercompany transaction, matches with the tested party. So this is highly intelligent to make sure that everything is correct. So in step 10, we need to make sure that if we are benchmarking, I will further explain in the next slides, a manufacturing of furniture, then we cannot have a wholesaler of bikes, for example, in this step. So we need to make sure that all the industry codes match the tested party and the intercompany transaction. And sometimes that means that it's not just one industry code that we include, but sometimes we need to make a combination of multiple codes to make sure that all the different aspects of an intercompany transaction are in the data set. And sometimes, but that's like 50% of the time, we have an other, and that's optional. In one of the next slides, I will explain what the other could be. And this could be done either in the database itself, or this could be done in the TP benchmarking, and it's both the same. So I will explain this one when I show you the tool. So once you have the strategy, this might be the eventual outcome. So you have a very large set to start with, and you are excluding all the companies as the deductive approach of the OECD, and you're making sure that you're deleting all the companies that are definitely not comparable, and then you end up with a set that you are going to check. The common mistakes or issues in this case could be, for example, a Boolean selection. So the database that we're using requires to have, in the end, a Boolean search to make sure that you include certain companies or exclude certain companies. So you need to make sure that in the end, this search that you want to have included and step 2 and step 3, but you don't want to have step 4, for example, that Boolean search is correctly inputted. Then there could be a change or a difference in the foreign exchange rates. So you need to make sure that that you could have a minimum turnover, for example. Then you could include a broader section of active companies, but that does include companies that are currently in liquidation status or dormant, because they are still somehow, to some level, active. So you need to make sure that you only include the companies that are actually active and actually in going concern. You have to exclude shareholders, as I mentioned earlier, so you need to make sure that there are no groups in the whole benchmark set, because you want to test the third parties versus third parties. So you need to make sure, combined with the Boolean, that you don't want to have a shareholder, and that should be on aggregated level and not a single corporate level. And of course, there is the risk that there is limited data available. So what we notice for example, a US region is that there are very minor financial or companies available, and that the companies that are available are usually listed companies. So it takes a huge risk with itself that you have a different or an uncomparable set with it. So you need to make sure on beforehand, with the industry codes, with all the different aspects of the search strategy, that those limited data will eventually yield to a nice comparable set of companies. And then there are some tips and tricks. What we often see is that designing of a strategy doesn't take a lot of time. So approximately 1 hour, and that is including, without at least, contact with the client or making sure that everything is set all right. We use data for multiple years, so that's also usually the case and the common practice with the OECD, that we use data for 3 years. So for example, right now we're benchmarking 2019, 20 and 21 together to get the new results. So usually we use 3 years, but often sometimes 5 years. Then the best practice with the number of industry codes is 2 to 3. Sometimes we see that for services, for example, we use a whole set of different combinations, or when there is a specific service that is highly technical and requires lots of different input, then we need to make sure that all those different aspects are also aligned with the client. So then we make a combination of multiple industry codes, but usually, as I said, 2 to 3 different codes. Then there's a double check. So sometimes what we are checking, or could be checking, the local competitors of the client. So it's possible to include companies to make sure that you can check, okay, does this company that is a local competitor, is that actually comparable to the client? And of course, eventually, the final point, the agent benchmarks, what we often see is that the agent benchmark is done through a different benchmark, usually a CUP benchmark, but sometimes that benchmark doesn't have hold sufficient data with itself. So then we need to change the whole setup. We'll do a different benchmark study for a different transaction. And we make sure that the agent benchmark eventually gets done by a limited risk distribution benchmark, but then we'll do a working capital adjustment. And in the end, I will show you how easily it can be done by doing such a working capital adjustment in the tool. So now we have had the first step. So we have had the client intake and the search strategy and database. And now we are going to start with the automated program. So we're going to start with the data filtering up until in the end, the audit trail and report. Everything can be automatically be done, or automated be done, not automatically. And that will be shown first with the data setup. So as I mentioned earlier, we have the 10 steps for the search strategy, but there are other options available. The other options available are different ratios. So the TP ratios that can be used in databases, or that can be used in tools, for example. The general idea of such ratios is to make the whole set of potential comparable companies more aligned with test parties. So sometimes the tested party doesn't hold any intangible assets. So we want to include a maximum assets, intangible assets to total asset ratio, because that's better aligning the whole set with the tested party. And we can include that for basically all those ratios here included. So the inventory you want to perhaps skip, or you want to make sure that there is a certain level of minimum turnover available, because we cannot simply compare a company of 100 million in an intercompany transaction to a company that only makes 1 million. The number of employees, the total assets, all these specific ratios we can use to eventually make the set better and more aligned with the tested party. And this is also, of course, part of the whole rejection, eventually, basis of benchmarking, and also, of course, approved by the OECD. So what I will do is I will share with you how this can be done very quickly. So here I have our tool available, and this is a manufacturer of furniture. This is our data setup, and here you have a list of the specific ratios that I just shared on the screen. And I want to make sure that this particular manufacturer doesn't hold that much level of intangible assets. So I can very easily include, by simply pressing the button on and off, that this company should have a maximum of 5%. And of course, this maximum is now set based upon the details that I have for my tested party. So sometimes it can be 5%, sometimes it can be just 1%. And so this is, of course, this changes every time. But I can do that for many different levels by just simply switching the oven on and making either inputting a minimum or either a maximum. Then the next step for making sure that you have a good automated program benchmark is to, in our case, use the parameter and keyword search. So the whole reason behind it is that we can easily highlight, signal words that are definitely not comparable to a tested party. If we're indeed in this case looking for a manufacturer of furniture, and instead the wholesaler of bicycles somewhere ends up in the set, that, well, it shouldn't be the case, but imagine it is. By inputting several words, we can make sure that that company will be highlighted, and that we eventually can easily reject a company because that will definitely not be comparable. So in our case, we will decide on some rejection and acceptance parameters, make sure that the whole system is running, and that we can easily check when we can accept a company or reject a company. So if I move back, this is our screen for parameters. So as you can see, I have multiple parameters already lined up. So we have rejection, and we have one acceptance, and we have different characterizations of accepting or rejecting a parameter. So for example, the whole finance, tax, legal, investment, and management is a rejection reason on function, and group companies, of course, a rejection on group level. But we can also include, for example, a product. So in this case, manufacturer of furniture. Perhaps we're looking at a new kitchen or a new bathroom or a bed or something like that, and we don't want to include the electronics. Then we can say, okay, I want to make sure that the electronics are rejected by a product. So for example, in this case, we have electronic, gadget, computer, or light that are definitely not comparable to the company that we're looking at. And by setting these different parameters, both rejection and acceptance, eventually we can go through the benchmark quite simple and quite clear and quite quick, I would say, without losing all the quality that you want to have. And then after the parameters, you start performing the actual benchmark. So you're checking companies to when you need to reject them or when you need to accept them. So you can, in this case, we have a multi-check and single-check version. The multi-check allows you to very clearly reject companies that are definitely uncomparable at first glance. And the ones that you're doubting or you definitely want to check a bit further, you move on to the single-check and you look at them a little level deeper. So then you can actually say, okay, this one is comparable or not. And the multi-check looks like this. So on the left, I have all my parameters that I have input in here. I preferably want to make sure that the no parameter hit is as little as possible, because that means that these companies don't have a hit on one of the parameters that I've input. I'll check retail because it's a manufacturer and I don't want to make, I don't want to have a manufacturer or a retailer in my benchmark set. So I'll check the company. This one doesn't necessarily have a retail function. This one also not the case, but let's assume that they both are. I can easily reject those companies by making a comment, and the beauty of it is that those two companies will have the same comment available to make sure that all the consistency throughout the whole tool and the benchmark is guaranteed. Everything is saved and stored and consistently. And then we move on to the single check. So I have companies that I'm doubtful or that I want to check further. I'll go to the single check and I will check them a level deeper. So I will check the actual website of a company, and I'll see here, for example, that this is very much alike. Then I'll make sure that the company is accepted. I will write my review comment here. And I'll accept it. And of course, I can do this on a different level. So I can also say I want to reject it, and I'll put my review comment in here. If I put my review comment once, the tool will save it. And as again, it will save everything. So for consistency, I can easily check, okay, I want to have this particular comment for this company or for this particular parameter.
Can you also show the website visual?
Yeah.
Thanks.
So the tool automatically scrapes the text and saves the website image. Yeah. So this is, for example, an actual website. So the tool makes a screenshot of the website in the local language still. So here you can see the different tables and chairs that this company apparently, I think, sells. And on the right is the translation. And I can check, okay, should this company be accepted or not? And that's how you check all the company websites to make sure that the company is comparable or not. So it's the full deductive approach of the OECD. And one other item is what our general approach is that if a company doesn't have a website, we want to make sure that the company is actually doing what they're saying that they're doing. We want to make sure that there is no website at all. So we search a company on Google by pressing this button. We make a screenshot ourselves and we upload it in here to have our audit trail available, especially after a couple of years.
So I think maybe just to add, Lisanne, that the idea behind our solution was to have all the users not having to go back and forth between Excel, Word, websites, making translation, making snapshots, and that you can do everything within the tool, or the tool will do it automatically for you whenever you select a certain accept or reject parameter. Also at the time that you're really looking at the website, so saving time, and also to avoid that there's a disconnect if you need to document audit trail later on in your process. You always have proof immediately when you are doing the actual activity. So that's critical, and that you don't need to exit and enter the tool again and again to save you time, basically.
Yeah, absolutely. Thank you for the addition.
Thanks. Once
you're done with rejecting, accepting all the companies, you have a nice set of companies available. We have the recap part of the benchmark, and this recap part is simply, of course, it's a recap. But especially as being an editor or a reviewer of the benchmark, I'm often a reviewer of the benchmark. I can quickly go through all these companies and prepare myself for the whole review. So this overview is what I receive, and I can say, okay, I want to have a further investigation or a further review of certain specific companies, and I can make sure that as a reviewer, I can review those companies. Then the next step is the page that we call PLI. It's step 7. This one has multiple input data, so we can have first the IQR selected, so the interquartile range. We always use the Microsoft Excel range, but as I mentioned, for some countries there's a deviation, and then we select, for example, the 35th percentile. The next step is to make sure that the profit level indicator is set all right for a manufacturer. That is usually markup on total cost. For a limited risk distributor that might be return on sales. But there are lots of other different profit level indicators that you can select that are best aligned with the transaction. And further, there are in this case, working capital adjustments. As I mentioned earlier, specifically for an agent, it might be the case that the working capital adjustment is required. We simply input in here the data necessary to make the working capital adjustment. Simple as that. The system does the whole calculation for us, and we can focus on the more added value of other things. Then the next step is the results. So of course the whole results lead to the arm's length range. It's visualized like this. So in this case, the system says for us, okay, the median is 2.7%. I'm being the reviewer, and I want to say, okay, what does the result, the eventual range doing if I want to exclude a certain company? Then the system automatically recalculates what the arm's length range should be. Of course, by simply allowing this company doesn't mean that I have now rejected it. I still need to go back to this specific company, and I need to make sure, okay, this company is uncomparable because of reason X, Y, Z. That is that we want to be qualitative. So we need to make sure that the whole benchmark is up to quality, and we don't want to simply say, okay, this company has a different result and perhaps an outlier, and because of the outlier, I want to reject it. We still need to make a functional reason why that specific company should be rejected. And then, of course, the review part. I see that there's a question. I'm performing a benchmark and I'm looking at the web page. I find more than one rejection reason. Is there a preferred rejection reason that I should choose from? That is a good question. Indeed, it could be the case that you're in single check and you have a company that you see that is indeed engaged as a, not necessarily as a manufacturer in this case, but as a wholesaler of bikes. Then both the function is wrong and the product is wrong. It might be better in this case to reject that company on that function, because that's simply stronger than the product. The product means that they're still a manufacturer, and that of course isn't true. If you would have a company that is engaged as a group, then that is of course the best reason, because we simply don't want any groups in the set, because we want to test the standalone results of a specific company. So good question, thank you. And then eventually the report and auditing. So in the tool we have of course the very easy option to prepare the report. So I can simply upload a Word document and I receive my eventual report. Everything will be saved and stored in the tool. So for whole audit trail purposes, I can easily retract all the data from it, and it will say, okay, this company has been rejected because of reason X. This company has been accepted because of reason Y. And simple as that, I have my full audit trail available and ready immediately at once to give to the tax administration when necessary. I shared with you the report. Yeah.
Okay, now I think a great overview. Thank you, Lisanne. Well done. Just very important to mention what we also showed you, what Lisanne showed you on the screen, was our solution for a goods and services benchmark. So typically, if you look at financial royalty benchmark, you can already within the database itself can find your comparable if everything works out. With the goods and services, you have the complexity of the audit trailing, the website, translations, and the parameters and keywords. So that's quite different. So that's just as a bit of context. Also important to mention is that this is the solution after you have done your search strategy within the database. So our solution assumes that you have your own license to an external database, very important. And also typically the tool is used by users that have a minimum volume of benchmarks themselves. So if you're in a practice that at least have like 20 benchmarks per annum, it becomes viable to save time. Also for training purposes, it can also be that you're involved in like APA type of environments, so more complexer environments, or that you need to have people within your practice that need to be able to do benchmarks. So for training purposes, it will also help you. So if you're interested in that conceptually and are looking for any form of automation, we offer a so-called 30-day free trial. We have our own website, you see it online. We will also send out the slides to you so you can have a quiet look at a time that suits you. And yeah, that's it. And just maybe also to, yeah, as next steps, maybe also some questions that you may have. I think there are some published questions. So let me see what is in the overview. So I think one of the questions is, what is your approach with extreme results? Maybe Lisanne, can you give an answer to that?
Yeah, of course. Yeah, with extreme results there, we don't necessarily reject a company simply because they're in a loss-making position or they are making, let's say, 80%. But it does indicate that there is a reason to further investigate why that company is generating an extreme result or a high result. So we always go back to that particular company, we'll check the website again, And if there is, for example, an intangible that the company has that we had missed initially, we'll reject the company because the intangible in this case may generate more income than in a routine environment. So we don't necessarily reject companies that have the huge losses or incomes, but we'll always investigate and recheck if necessary.
Okay, thank you. Next question. If I don't apply the median, is that always wrong?
No. There is the whole interquartile range. So let me go back to results. This is the interquartile range, and the arm's length range is from the lower quartile up until the upper quartile, and being median the safest point in the whole range. So if you apply median, then that's the safest point, but if you are between lower quartile and upper quartile, then that's still at arm's length. So it isn't wrong if you're within the range.
I also heard that some territories or some authorities don't accept anything below the median.
Yeah.
Like China, I believe. Do you have any experience with that, or?
Yeah, we do indeed. Yeah, that's indeed China. Indeed, is a case there where nothing below lower quartile is needed. Below median is accepted. Sometimes you see indeed that there's between median and upper quartile. Sometimes even the company is without, not in range of this particular benchmark, and it still gets accepted by the Chinese authorities. That they're even higher than upper quartile.
Yeah. What I also see personally with applying the range, that typically if you are doing a price setting in advance,
yeah.
And if you are, say, doing the actual check, the actual performance versus the budget, and if you are below and above the range, what do you tell clients if that happens, or how should they implement that from an adjustment perspective? Are they going to the median, or do you say, no, it's good enough to go then if you're below the range that you go to the lower part of the range, and if you're above the range, you go to the upper part of the range? Is there any?
Yeah, it depends, of course.
Best practice there?
Every company is a bit different, and the safest always is the median, but there are, of course, reasons, especially now with COVID, for example, that you could say, oh, the lower quartile is sufficient, or perhaps the upper quartile is sufficient. That depends on the actual circumstances of all the different companies. So, but always median is the safest point to flow back to. But it doesn't necessarily that it has to be median.
Yeah. Okay. I know, Lisanne, you come from a practice where you have done things manually in an environment, and you are now working for a number of years with our solution. What was for you the game changer, or at least your change management? How did you encounter, and how did you feel the change?
It's like you shared in the beginning. You have this Word file and you have this Excel file, and I had, I think, another Word file. So I had 3 separate files open, plus Google, of course, to check the companies. And I had to do manual screenshots, upload them, not upload, but copy them into Word. I need to make sure that the rejection reason is set all right. And then I have to do that again and again and again. So all the tedious work basically that is necessary to have your whole audit trail available, I had to do manually, and that took, I don't know, but it took a really long time to have all those separate elements available. It's just not necessary to do that. It takes a lot of time, and you can do so much else with your time, being more valuable to more clients or to other particular items of this client, that don't see the value in doing it manually anymore. It's highly intelligent to do it with the software and to have it automated.
Yeah. Thanks. Yeah. At least we have a lot of users today. We already have this tool for a number of years, and we have a lot of references. And what we also hear back often, that it increases the happiness of the people using or doing benchmark. Is not often seen as a very nice workflow to be done. Yeah. At least the manual part. The training becomes much more relaxed to do so. And just to give an idea, that if we set, say, a target together with a user to look at time saving as a KPI for introducing the solution, the end game within half a year is at least to go back to 50% of the time spent compared to the manual workstream. So also these times with difficulties to find resources, we also see that those KPIs can be met, and helps you also on your resource constraints there.
Yeah, if I may add, there's also an example of a recent audit that we had for a client, and we had done it in the tool, but we also had it manually. And if I can see the difference, how quick we could retrieve all the information from the database from our tool versus the manual one, I would say the one that we had stored in our tool was so much better than the whole manual one. It took way less time to have everything in one folder and clear to go to the tax administration, in this case to Italy, where they are already so harsh and sometimes being difficult. So it was very nice to have everything in a tool and just simply say, here's everything, client, please forward.
Same in Germany. That's you need to have the evidence, the audit trail, how you got to your end result. So in that sense, I fully agree with you. Okay. Any final comments on your side, Lisanne, or?
No.
Yeah. Then I wanted to thank you. It's very nice to do it together with you. Also, thank you all for joining, looking at the webinar on how to perform best practice benchmarking. I hope it was sufficient content. If you have any questions, feel free to reach out to us. You can also go to the website as per the slides and to see whether you are interested in a free trial experience. And I hope to see you in our upcoming webinar, which will be next year. So for now, I also wish you already happy holidays and see you very soon. Thank you, sir.
Thank you.
Yeah, thanks.